In our private videos, we're talking about the unfunded commitment. Then we're talking about the investment entries. Those are for the investment portfolio companies. Now, in this video, we're going to bring the money back to the fund and then distribute to the investors. So these are the distribution entries. Capital distributions return cash to investors, typically from the sale of investment or fund. In our model, we set two types of a distribution by the end of the year. We assume we sold this AI tech company. We assume the apartment complex loan has been prepaid. There are two steps to book the distribution entries. Step one is to record the sale. We would debit the investor capital account for the amount distributed. Then we'll credit the cash to reflect the amount returned to the investors. Then step two, we're going to distribute the profits to investors. We're going to debit return earnings or realize the gains and credit the cash to reflect the profit distributions to investors. Now let's walk through our examples. In our business plan, we assume the AI company has doubled the value when we exit. And we assume like 20% of the cost, then we got the net proceeds about $7.366 million. We're going to distribute these proceeds to the investors eventually. So we're going to book the sale. We're going to debit the cash. This is the cash proceeds received from the sale, $9.2 million. These is referred back to the original business plan, this exit proceeds, D54. If I change this number, the entries and the financials will be all automatically updated. In this entry, we have our original investment costs. By crediting the investment at fair value, we're going to remove the sale of the AI tech investment from the balance sheet. And then we are going to book the difference between these two numbers to be our realized gain or losses if the value is under the water. After these sale, we're going to book the distributions. We're going to debit the investor redemptions for the distribution of the net proceeds. And then we're going to credit cash for the payout to reflect the redemption payment made to investors. For the loan schedule, we originally set up of 16 months. However, by the end of this year, we decide to make it a prepaid. Then we have the ending balance, $2.753 million. These will be the proceeds we get back from our borrower. We will credit the note receivables. This is a recognition of the note receivable from the prepaid proceeds. Then we're going to distribute the principal back to the investors. And we will have our investor redemption debit, $2.7 million, and we are going to credit our cash. So these are the entries. And then we bring these entries to the general entry tab. So this is a sale for the AI company. This is a distribution for the AI company. This is the prepay loan, and these are the principal payback to the investors. And these are the monthly activities. Because all these activities happened by the end of the year, we will bring back to here. We can tell this $4.6 million is the AI company. We're going to have the value decrease. And then the other part of our valuation is notes receivable. So our value decreased by $4.6 million in November because we have entry here. And just put the entry in both way here. And we booked the entry by the end of January. But our distribution happens in December. So the cash decrease happened in December. And this $1 million is the unrealized gain we book later when we do our valuation. Right now, we only handle these two. And for loan note receivable, we decreased by $2.8 million. These include part of the principal payback plus this $2.753 million prepaid proceeds. So this is how we reflect in the monthly activity for these entries. Meanwhile, these redemptions, including the loans and the AI company sale, we have increased the redemptions in the equity part. As a result, in our balance sheet, this is our valuation ending balance. Now we only have this laundromat and the e-commerce in this case. And these are our cash and this is our loan receivable. All these numbers is just the sum of the entries from the trial balance. This is the distribution. And then we have a $10 million distribution, including the AI company and the prepaid loan principals. This is our cash flow. We would have $4.6 million realized gain in the operating activities, and we will have the equity proceeds and the loan receivable cash flow change here. Then we will have our distributions. So this is how the cash flow change after we have these equity and loan activities by the end of the year. Then this is our schedule of investment. Right now, we don't have any cost for the AI tech company. Instead, we have $4.6 million realized again, and our loan is gone and no cost of value. So by the end of the year, our SO schedule of investment, we have cost of $64 million and a $7.4 million valuation. So these valuation, we were comparing the balance sheet H10 and H18. Let's go back to H10, H18. So this is our equity investment fair value, and this is our loan investment. So these two ties back to our schedule of investment. And then this is the equity breakout for every single investors here based on their ownership. And we have our redemption total here, and these are just allocated here. Then this is a realized gain. We're going to allocate among these investors. So these are the summary between the GP and LP. And this is the capital account statement for each investor, see if we want to print. Now we have booked all the entries for the capital activities to show you how these numbers flow from the entries to the financials and other reporting document. Next, we're going to dive into the details of the operation expenses and the income.